I think that's too early to say. We are still missing the details regarding the content of sanction. And I think the response that we observe on markets across the board in Europe is a response regarding the lingering uncertainty. Lingering uncertainty regarding energy prices, regarding what that means for the growth outlook. So it's not really, I think it's fair to say that it's not really about sanction. It's more about, how much the pre-existing, I would say, in our view, constructive growth outlook that Europe had before this latest dramatic event can be affected or can be derailed, if you want, by what happened. So overnight, we've, of course, taken into account the latest event. We've downgraded, shaved a little bit of European growth away, and we are now a little bit below 4%. But, going back to your first point, I think this is more uncertainty. It's about, the economic outlook rather than anything else.
Understood. But I want to talk a little bit about the way Russia is, of course, impacted by the sanctions. That's the point. It's becoming so increasingly isolated, especially from a financial services perspective as well, and we could expect to see further rounds of sanctions. How fit is it to go alone? Are we getting into the realms of like a dual circulation strategy a la China?
So, look, let's think about what that means. What are the channels, the main channels that can actually connect Russia to Europe right now? Okay, we have to think about trade, we have to think about energy, we have to think about financing condition. These are the three. These are the three channels that we have to look at. If you put together these three channels so far, as I mentioned before, the effect that we are talking about on the European economy is certainly not negligible. It's not something that you want to neglect, but we don't have to get over ourselves here and trying to respond too much given the amount of information that we have so far. So once again, you can build a more negative scenario there. We've also considered the possibility of a more severe scenario, one in which the current tension push energy prices a further 30% up, so that impacting the real income and the ability to consume by the European population even stronger. But even if you go there, we are still talking about a reduction, in our view, of GDP by 0.4%. That's, I think, what we know until now. And I'd say, once again, it's a bit too early to make geopolitical consideration regarding how more we can extract in terms of the relationship between Russia and Europe, or, of course, the role of China.
Filippo, this week I came across a 2005 paper from the Fed, a policy paper written by a couple of Fed officials back then, and it opened with this line: every U.S. recession since 1971 has been preceded by two things. Number one, an oil price shock and an increase in the federal funds rate. We've seen oil move above $100 a barrel in quite quick order. We're also now looking at the Federal Reserve raising interest rates several times this year, and debate around the ECB doing the same. Should we be more concerned that a recession could be coming?
Certainly, the latest events are hitting on growth, as I mentioned, but we have to consider what are different policy landscape where the latest dramatic events are hitting on. We're talking about economies that have substantial room to grow still. We're talking about economies that have set, substantial fiscal support, especially in Europe, more persistent than in the US, to deal with the recovery and to deal actually with the structural transformation of this economy. So the risks do exist, but we have to recognize, and this is really a striking difference in comparison with the past, the general support, policy support that is pre-existing to this latest shock. And then neglecting this, I don't think would be a good choice. So that's the reason why, we are, as much as we are thinking about risk and heavily, and we think that policy decision moving forward, including the ECB, will be what we say more data dependent. So essentially, they will look at the evolution of what will happen in the future. Given the lingering uncertainty, we're still talking about a substantially more growth conducive environment in terms of policy, in terms of real economy, now than we had, with other oil shock that happened in the past.